Thank you, everybody. I appreciate, David, I appreciate your introduction. Seth and Michelle, thank you for your invitation to join you. I'd like to encourage you, as Michelle already has, to ask questions or offer comments, offer your own experiences, contribute to the discussion however you'd like. I've got a variety of things to go through. I look forward to touching on them, but this is such a broad and complex topic, analyzing private companies, that there's no way we could do it unless I kept you here for the entire week, and then I would run out of things to say anyway. So I encourage your contributions, but also I'm going to try to hit on a variety of topics here that I hope at least spark the conversation and some of the highlighting some of the challenges that we find our client base is wrestling with on this interesting topic. This discussion is really about private companies, not about rapid ratings, but let me just for context very briefly explain that we are a quantitatively based ratings firm. So we are not qualitative in the sense that we are not credit analysts in the sense that you would find at the big three, the traditional rating agencies. Everything that we do is based on having access to financial statements from public and private companies. We're paid by subscribers, not by issuers. So we have no contact with the companies that we're rating in the ratings process. And our customer base really ranges from financial institutions using us for investment purposes, both analyzing and identifying investments, as well as the risk management and oversight of investments, all the way through to corporations using us for understanding and pricing credit risk, to looking at their accounts receivable, all the way through to their supply chain risk management purposes in their procurement and vendor management processes. What we're going to try to touch on this evening is really the following. I'd like to talk a little bit about private companies and where they fit in the macro landscape. I'd like to talk about accessing private company financials, the private's ownership structures, their access to capital, and then utilizing their financials, what you actually do when and if you're able to get them. These are, as I started by saying, some of the many topics, but hopefully within this we'll be able to cover some pretty broad ground. So for further context, we're finding that more than ever before, the investment community and the corporate community are understanding a need to dive deeper and appreciate and understand their counterparties more than they ever have before. Now, this is partially an evolution of disciplines like supply chain risk management, going from understanding operational risks to understanding financial risks, but it's also very much a result of the recession and the financial crisis, and a realization that counterparty risk itself is just a critically important issue, and it's not going away. Boards, from audit committees, across the board, CEOs and on down, as well as line managers up, are appreciating the need and forcing the growth and the adoption of new techniques within companies to appreciate counterparty risk. Counterparties for us are broadly defined. Customers, trading partners, banks, suppliers, investment opportunities, and the list, of course, can go on and on. But understanding the risks of these companies for credit risk and pricing, for cross-asset class investment identification, to enterprise risk management and understanding on a common basis the risks of companies, whether you're dealing with them as a vendor or dealing with them as an investment or as a customer, is becoming more and more important. And then governance, reporting, accountability are all critical themes that we think are growing and that we're hearing our customers be particularly concerned about. And then private companies represent, we would ballpark, between 70 and 80% of counterparties out there that our customers across our user groups are wrestling with. So the availability of financials and what you do with those financials as a percentage of the total counterparties that people have is huge. Now, I have to thank Seth for this. I don't know whether you can see this very well. This is my son, and Seth came to a presentation that I made in California a couple of months ago, and it's the first time I had ever actually chucked one of my family members into a presentation for fun, and he encouraged me to do it again, either thinking that he provided some comedic value in his little Mona Lisa smirk here, or the actual moral of the story. So my son is now almost 6. His name is Hutch, or Hutchinson. He was about 3 and a half when this picture was taken. So he was in preschool, and he had a girlfriend. His girlfriend's name was Nora, and he was very excited about Nora, and Nora really liked him a lot, and they spent a lot of time together at school. One day he came home, and he was just viciously upset and physically downtrodden, and his shoulders were bent over, and he kind of stumbled into our apartment, and my wife asked him what happened, and he said that Nora wasn't his girlfriend anymore. And so that's obviously very sad, but you could tell he was physically just heartbroken by this. So she called me at the office, and I said, I'll talk to him when I get home, like that would do anything. And I got home, and I said, Hutch, what's wrong? He said, Nora's not my girlfriend anymore. I said, that sounds terrible. What happened? And he said, I don't want to talk about it, proving that he's almost a teenager. And I said, well, come on into your room. Let's talk about it anyway. So we got into his room. I said, so what happened? He goes, I told Nora she was stupid. And so I looked at him and I went, well, you know, that's never good with your girlfriend. You kind of, that doesn't work. And he goes, I know. I said, so that's why you're not her boyfriend anymore? Yeah. I said, well, what do you think you need to do about this? And he thought about it, and he thought about it, and he thought about it. And then he looked up and he said, I think I got to get some more girlfriends. Proving that even at 3 and a half, understanding risk and hedging yourselves is an extremely important topic, and it's inherently important. So private companies, typically viewed as being small, typically viewed as being in the SME category, and generally defined as 500 firms or less. I'm not saying that I necessarily agree that they are all small. They're certainly not. But I'm curious if anyone has a view on how many of the top 100 companies in the U.S. market are private. And for fun, I'm going to offer that we will rate 2 private companies of your choice for you on a discrete basis for anyone who can get within 2 of the answer.
46.
Anybody else? 12?
32. 20. 48.
Anybody want to take the under? 5. Cargill, Coke, Mars, Price Waterhouse, and Bechtel. So it's interesting because when we started to assemble this data, I was thinking it would be around these same kinds of numbers too, not expecting there would be this few in the top 100 by market cap or really by revenue, I guess. So how much contribution do these companies make to the economy? The answer is as individual firms, obviously they make small contributions, talking about all private companies as a whole, but as a group, they make a lot. I'm not going to read through all of these, but you can see that in terms of job growth, in terms of payroll, in terms of non-farm private GDP, these are huge contributors. Now, another way to look at this is, as goes the economy, goes the health of many private companies. So as a benchmark, looking at broad macro indicators is going to give you some color on what's happening with the private company community, and they, as counterparties, can be evaluated to some extent just by understanding what's happening in broad economic terms. So in 2008, small firms represented 99.7% of all employer firms. Again, lots and lots of private companies. 65% of new jobs between 93 and 2009. And over the last year to year and a half, you're starting to see more hiring among this community. One of the things to keep in mind with greater hiring is greater needs for cash. Where are new jobs coming from? Again, more of the same statistics. Now, this is interesting as well. Bankruptcy data. 2011, in the US, we had 47,000, almost 48,000 bankruptcies. And that was down from the prior years, which is positive. And if you were to look at Q1 2012, we were down to 10,900 some odd. So again, quarter on quarter, you're continuing to see a decrease. But second challenge for the room, what percentage of that 47,000 were public companies? Or keep it consistent, what percentage was private?
90%.
How many?
90% private.
Anybody else?
25.
Anybody else?
99.
99. This is also reasonably sobering. For those of you who do business with smaller, younger companies, only 25% last 15 years. 70% of new employer firms survive at least 2 years. Now, we all know, just intuitively, because everyone probably knows people who have started up companies, it's a difficult thing to do. Entrepreneurialism is an art, and being able to run companies and grow them beyond that startup phase is in and of itself a very interesting process and is a challenge. So the first one makes sense, second one. But when you start getting up into the 15 years, seeing that 25%, I think is pretty fascinating. If anyone would like this presentation, we'll certainly make it available, so I'm not going to go through all of this. But this is a pretty interesting study that PwC did, came out with earlier this year, that talks about effectively what the CEO's views are of risks, optimism, both for domestic and for international business opportunities. And not surprisingly, more of them are optimistic this year than they were last year. And not surprisingly, more of them are optimistic this year than they were last year. More of them were concerned about international exposure. So where do private companies interact with your business? In looking at the attendee list, it looked like we had a really interesting mix of people in terms of what you all do, where you all come from consulting to regulatory to corporate credit risk, financial and investment advisory. So private companies interact in lots and lots of different places. But we see big concentrations in people's vendor groups. Whether you're a financial institution or you're a manufacturing company or a services company, your vendors or your suppliers are probably where you're interacting, or your firm's interacting with the most private companies. But customer bases as well for the corporate set and for financial institutions, obviously those with private placement portfolios investing in private companies, and or anyone on the underwriting or lending side, whether you're an insurance company, whether you're a bank or an alternative provider of credit, you're interacting with lots of private companies. We find, just interestingly in vendor management, it's a very inconsistent approach that companies take. So if you look at the Fortune 500, you would find a huge disbursement of how people are approaching vendor management and how much financial risk and credit risk they're actually doing. And it's a burgeoning field for the financial risk management, but it's really very interesting to see how broad the approaches are and how early stage many of those approaches are. And then, of course, regardless of how sophisticated a credit department may be or how sophisticated a supply chain risk management or vendor management department is, we actually see very few companies using the same metrics and the same tools across businesses to understand their counterparties. So the concept of enterprise risk management itself is a is one that for financial evaluations is still very early and an interesting part of the market as well. So when looking at privates, obviously one of the biggest challenges is how do you get the financial statements? Some companies get them because they can command them. If you're a lender, of course, you're going to get the financials. If you're an insurance company, the broker is going to give you financials on the underwriting side, not the investment side. If you are a corporation, you may be getting them. You may be asking for them and not getting them. You may be asking for them and getting them. You may never ask for them. You may have in your contracts that you can ask for them and you still don't. And then you've got some companies that absolutely will not do business with a private company unless they've given financials. I don't know what the percentage is on that, but it's small. And this is evolving. We're certainly seeing companies get more aggressive. We're seeing regulators get more aggressive. We're seeing exchanges get more aggressive in recognizing that they're in a position to require financial disclosure from privates. What's the first thing that private companies do? Sorry, please. You can interrupt anytime you'd like.
In what capacity do exchanges have access to financials and privates?
Well, you're seeing, for instance, the members of exchanges that are private entities. The futures market is a good example, right? We saw MF Global as an FCM blow up last year. There are FCMs that are private entities, and other members of exchanges are taking contingent liability risk of having the exchange itself taking the risk of other members. So you're seeing a broad counterparty risk focus begin to permeate into where certain exchanges are recognizing that they have a counterparty risk relationship with their members, and that is an important thing to understand. And while there are not a lot of private companies that are members, there may be private parents or there may be private members with parents that are public, but it's another layer of the risk management effort in unwinding the layers or peeling back the layers of the onion. So with private company financials, if any of you have, and I'm sure most of you have, tried to get financials from a private company, and what's the first thing that happens? They tell you to get lost, right? So it's easy for a private company to say, well, we're private, so we don't provide our financials. And that is a first stop that many companies use as a method, as a defensive measure. Now, some will give them because they already know that their financials are extremely good, they feel very confident about it, or they know that the materiality of the relationship is such that they just have to disclose. But otherwise, they typically will say no. And why do they typically say no? Because the people asking usually accept it. And they don't necessarily ask again. But if you ask again, and you ask again, and you explain why you need them, and it becomes part of a relationship management discussion as opposed to a confrontational element of a relationship, we're finding a tremendous success. We have a hit rate when we solicit financials, private company financials for our clients, we have a success rate that's approaching 80%, which is higher than I would have expected when we launched the service, but is something that is part and parcel to the relationship management as opposed to being part and parcel to a red light, green light type of we're going to work with you or we're not going to work with you. So what is your company's or your client's policy, philosophy? These are questions that are important to know. So a policy that disclosure is required obviously makes things easier. Anyone who wants to work with you is going to understand that. It's going to be up front. It's on the table. It's a point to discuss.
Are these questions typically expected as part of an enterprise risk management strategy?
It's becoming more, they're becoming more prevalent, but I wouldn't say they're expected historically because a lot of this is evolving as we go. What we find is in credit departments for corporations, not those evaluating, say, underwriting risk, but those evaluating terms and pricing for the sale of a product or service, they tend to have materiality thresholds. So Anything, let's say, under $100,000, they're not looking for financials. They're not really doing much credit analysis. It could be 250. It's another threshold we see. $1 million is another threshold we see. But then if the order is large enough and it crosses one of those thresholds, then it sort of moves into a whole nother level of analysis. The other element of it is, of course, relationship. So you see a lot of firms using history of relationship as a proxy for quality, which is a mistake. It's an important element. If you've been doing business with someone or a firm for 20 years, you can't evaluate it quite the same way as you would a new opportunity. But to assume that someone you've been doing business with for 20 years has financial strength because you've been doing business with them for 20 years is a sure sign of an eventual problem, because everyone is suffering through the ups and downs of this economy. So, what are some of these challenges in the disclosure? As we already talked about, there's a reluctance to disclose. There are big concerns over confidentiality. How you compare the privates to publics once you get them. How you follow up in the process. Let's say you have a credit team or a supply chain team that has 500, 1,000, 5,000, 40,000 counterparties. Unbelievably time-consuming to go out and, as well as doing all the rest of your supply chain risk management or your credit risk management or your underwriting jobs, to actually go out and do all of the follow-up. In a lot of cases, people who are assigned these tasks are simply uncomfortable asking for something that they know will be, where there will be some friction. So it can become confrontational. And then the big question, what do you do when you get them, if you get them? So we certainly encourage people to focus on a policy, establish it, be open with it, explain it, have it be an early part of conversations with any new relationship, and have it be something that possibly gets phased in over time with existing relationships. But again, disclosure and openness on a policy is the best way to get it adopted. Ensure confidentiality, whether you're using a third party or you're keeping the data yourselves. Make sure that the integrity of that data and the confidentiality of it is absolutely buttoned down, because that is is one of, if not the most important discussion that you'll have with private companies. Emphasize the collaborative nature of the ask. So the more you understand the private company, the more you can help them through difficult times, the more you can be working together to find additional ways to enhance the relationship, as opposed to making it a confrontational issue where, if using a supply chain context, if I've got a supplier and I'm telling them that a rating or a quality of X and below means no business, that's a very different discussion than one that says, if you are having a problem, we'd like to know about it, because the earlier we know about it, the more we can do together to fix it. And that together can be an investment, it could be an acquisition, it could be advice, it could be resources, it could be buying from a Tier 2 supplier on behalf of the Tier 1 supplier, it could be accelerating payment terms, it can be all sorts of things that can be additive to the relationship and ultimately worth the while of the company making the disclosure. An education process to explain what you're doing with the data, how you're using it, what you're doing and not doing with it, not making it public to anyone else. So they give it to you, it doesn't go anywhere else. It's only used internally. You may have a team of 5 people who have access to the data, making sure that that private company knows that it's only those 5 people. If they all have confidentiality agreements, making sure that the nature of the internal confidentiality is explained and your private disclosure is educated. It's extremely important. Establishing thresholds we've talked about. Layering in a demand right in documentation. So having it be something that is optionality for you. You may not need it, you may not want it, but having the ability to access it at a time of need is going to be a critical asset in your contracting process. And then you can provide the financials, you can use the financials internally, they can provide you the financials, or you can have a third party solicit the financials, depending on what is best for your work process. And we get asked a lot about the integrity of financials. So David, you and I were talking about this before. Can you flag for problems in financials, whether there's fraud or mistakes? We get asked a lot about audited versus unaudited financials. Our view is that, of course, if you get audited financials, you've got another third party that's looking at them saying, okay, this is fine. But when you're getting private companies, particularly the smaller to mid-size entities, you're going to have auditors that are not the biggest auditors. So you're not going to be able to rely on them as the ultimate authority. It's just someone else who's looked at financials. But this is an interesting snapshot. A snapshot of a set of audited financials on the left and a snapshot of financials that come from management accounts on the right. Now, the third-party view aside, which one would you rather have to evaluate? You certainly get a lot more information from this set than from that set. So as we see people talking about privates and the audited versus unaudited question, we see everyone wanting audited, and that's fine. That makes sense. But to walk away from the information value of a set of unaudited financials is a mistake. Because you might get a set of QuickBooks, you might get a set of management accounts, you might get their weekly accounts, and the amount of information you can glean from that is extremely important and very valuable and not to be thought of lightly.
The arrow key should work.
Okay, so what do you do when they really won't give it to you? Well, some privates will disclose financials embedded in their parents' financials, obviously if they're a subsidiary. There are some non-U.S. jurisdictions where private companies have to disclose financials to a central depository, and they're then therefore accessible for a cost. We suggest collecting whatever you can. Obviously, you're going to use all the publicly available information and you're going to Google till your heart's content, but there are lots of resources out there that can give you additional information. Sorry.
You mentioned obtaining private financial statements from foreign jurisdictions.
Mm-hmm.
Any examples?
UK,
And what agency?
Companies House. So all private companies in the UK have to disclose financials to Companies House. So you can just buy them there. Now, it's a little erratic what you're getting, but it's better than nothing, and it's a mandatory disclosure. So, and there are others, but that's certainly one that a lot of people have counterparties, customers, investments, and suppliers in. And then making assumptions, profiling a company, looking at comparables, trying to get a sense of what the financial structure of a company looks like, simply by triangulating as much information as you can. We don't need to spend a lot of time talking about all the credit assumptions one can make about a company, but certainly some information, some analysis is better than none. So ownership structure, also critical question. Is a company you're looking at independent? Is it a subsidiary? If it's a subsidiary, what kind of support, explicit or implicit support, does it get from the parent? This is something, parent-child relationships and financial support is something that's been sorely tested. And I don't think anyone can rely on a parent absolutely, under all circumstances, defending a subsidiary unless they have an explicit guarantee. And even with an explicit guarantee, you certainly want to look at what the contracts or what the docs look like. But understanding the nature of a company's ownership is critical. Is it structured as an LLC? If it's structured as an LLC, what rights do they have and what history do they have in dispersing cash? Same thing goes with co-ops. Same thing goes with master limited partnerships. How cash is removed from a company, what a tight founders group is doing with cash in terms of comp as opposed to dividends. What's above the line, what's below the line. These are all critical questions. Is the founder of a private company the sole owner? Is it the majority owner? Does it have third-party shareholders? Are those shareholders individuals? Are those shareholders institutional investors? What types of institutional investors? All important questions. And then is a company a private, meaning it's truly on its own, or is it private because it has sponsor ownership, private equity ownership? Another important question after explicit and implicit support from parents is, who are you negotiating with? Who's the contract with? A lot of private companies will play games with the entity. A lot of public companies will play games with the entity with which you're contracting. Is it actually an asset-owning entity? Is it an entity that's designed purely for contractual obligations, but in a bankruptcy proceeding, you wouldn't have a lot to go after? Who's the signatory? Is it a senior management member? Is it somebody who is critical to the business or someone who isn't critical to the business? Important issues. Is there management concentration? So you've got the Mark Zuckerberg issue. It could be a huge company with a lot of shareholders, but if there's one person who controls the decision-making in the company, you've got risk concentration. What's the diversity of experience? You see a lot of private companies where you've got a handful of managers who occupy multiple roles. They may not have the experience for those roles. They may be excellent, but they may not have the experience to have handled all the different situations that you with them may ultimately experience. How diverse is that management group? Smaller governance issues, smaller private companies tend to have looser governance. Again, concentration of authority, concentration of power, fewer disaster preparedness plans, security plans, and so forth. So again, structural risks. Now, can anybody guess what the next slide will be? Private equity. Now, I don't happen to subscribe to this as a characterization of private equity, but I know a lot of people do, so I figured might as well just throw that picture up there. So when a company is owned by a private equity firm, what does that mean? Generally speaking, it's probably a larger company than a smaller company, so you've got something to rely on there. Of course, the traditional private equity model is a much more heavily levered model. So you're going to see ratios, if you're just doing a ratio analysis and just looking at, say, 2, 3, or 4 leverage ratios, you're likely to see higher debt or worse coverage ratios in that company than you will in others that you may be working with. But they tend to be more sophisticated from an oversight perspective. They tend to have more reporting. Private equity firms, of course, tend to be reasonably sophisticated groups, but there's a wide range of private equity firms. There are good ones and there are not as good ones. Equity sponsors can typically help a company if it gets into trouble. So there is some sort of deeper pocket, some sort of avenue when a company is in trouble and it's private equity owned. But the quality is critical. There are, like in any industry, there are good players and there are players who are going to play it a little bit faster and play and cut corners. And you want to be very careful if you're doing business with a private company and they're equity and they're sponsor owned. You certainly want to know as much as you can about that private equity firm and the way they traditionally handle their portfolio companies. IPO market conditions are also very important. So private equity firms traditionally have made their returns by selling their assets or IPOing their assets, selling them off. That's been reduced lately. You're seeing more companies moving private equity portfolio entities to other private equity shops. You're seeing more on the M&A side, even though the M&A market has been less active in the first quarter than I probably would have expected. But you see down here, as a percentage of the total IPO calendar, private equity-owned businesses represent a reasonable chunk. So as goes the IPO world, will go the potential exit strategies for private equity-owned companies, and paying attention to that is an important factor in your evaluation of those counterparties.
So are the private equity companies much more likely to give you financials?
We don't. I can't answer that. It's not that they are more likely or less likely. They tend to hold things close to the vest, without a doubt. But we're seeing about the same kind of disclosure. But there are fewer private equity-owned companies that our clients are dealing with as counterparties, just because it's a smaller percentage. So it's probably about the same. But it also goes back to what the private equity firms are, and where in the life cycle the actual entity is. So they're closer to an IPO. If they're being shrouded, they're less likely to disclose information. If they're in a growth portion of their life cycle and they need whatever your relationship is with them, they're more likely to give it. So I think there's always, even in the private equity universe, there's always going to be a little bit of that the balance of power and where the balance of power lies. If you, as a requester of information, have that balance of power, you'll have more access to the financials. I'm going to just skip through this one quickly, but you'll see that in the first quarter this year, we've seen a massive reduction, quarter on quarter, in private equity investments, but a lot of dry powder. So there's a considerable amount of private equity investment that can happen this year that still hasn't happened, and you've seen a drop-off in the first quarter. So let's talk about access to capital. So access to capital for private companies varies widely. So the smaller the company, the more likely the founders are providing the capital, or a smaller universe of individuals will be providing the capital. Bank financing, the credit and equity capital markets are, of course, an option. Receivables and asset-based financing are options. There are others, but these are some of the biggies. Understanding what a private company's access is, what they've done historically, what the nature of their cap structure looks like, and where the sources are, and what the maturity schedules are is, of course, important. Recent conditions over the last, let's call it 2 years, have varied dramatically, particularly for capital markets access. And we've had it for the small to mid-size entities. Bank capital has been consistently poor, but for the larger companies, it's been easier. The forward maturity calendar we'll talk about in just a minute. That is one of the really important things to look at, and one of the market dynamics that's changed significantly in this past 18 months. So small business financing. You see, young firms, roughly 3/4 of their financing has been provided by the bank markets, credit cards, things like that. So non-large liquid capital markets. 33% of young firms don't access capital at all. And when capital is scarce, as we're seeing for certainly the small to mid-sized companies, these are some of the alternatives they've got, and these are some of the things that they do. They will tax their credit lines. They will hit their overdrafts. They will access trade credit when it's made available. They'll extend payments. And net-net, they're putting pressure on the relationships with you if you are selling to them.
Curiosity here. Have you identified any leading indicators like of capital scarcity, cash flow, strangulation? Any of those have been among a variety of companies in aggregate?
Can you repeat the question?
Yep. So the question is, are there leading indicators that we've seen that are driving the access to capital or scarcity?
Or I'm looking at the other side. Can your data be used as a leading indicator? Can you aggregate your data? For example, if you see across your entire portfolio credit line consumption increase from 40 to 70%. Is that a reliable leading indicator?
So our data as a leading indicator for what capital to provide and access.
Like what's happening in the general market?
Yeah, and the answer is yes. So our data looks at 62 different ratios per company with 24 industry models. So we're really diving down into the industry specificity, what the importance of those 62 ratios are in each individual industry. But we look at sales performance, profitability, leveraging, working capital efficiency, debt service management, and cost structure efficiency. So within all of that data, and it's voluminous, there's a lot of trend line information and a lot of benchmarking that can be done. And one of the important messages that we'll get to in a couple of minutes is that one of the critical aspects of private company analysis is making sure that you save that data. Because private company data, once you get it, is invaluable. Saving it, storing it, knowing what to do with it, and being able to analyze it, whether you're a lender or or some other capital provider, is valuable.
Idle brainstorm here, but would you be a unique source of that information for an econometric model?
For econometric modeling, yes, we are a unique source because our data is proprietary and it is unique, and we have econometrically based funds that use us as an input, either as a factor into a model or as an overlay. And we're very close to launching a handful of equity indexes that use our data as an overlay on, or as a way of establishing constituent companies for indexes for specific investment purposes and the creation of things like ETFs and ETNs and whatnot. So credit conditions for private companies, what you see in all of these graphs is basically the message that for small to mid-sized companies and private companies, access to capital is still quite tough. So the majority of commercial and industrial loans in this uptick that you saw in 2011 is going to bigger companies. And a reasonably significant drop-off. What you've seen in a variety of other data that's come out more recently is getting at the fact that while credit has loosened for things like auto loans. Credit has loosened in terms of the covenants and the structures of deals for the same companies that had credit available to them last year, but not widened to incorporate a larger group. Demand. This chart pretty much graph pretty much tells the story. Increase in demand for loans.
In that case, in the global sense, do you think that represents recovery or?
It could. Does it represent recovery? I don't know. It could. It definitely represents a desire and a need to invest. Whether it's a desire and need to invest to make one more viable or to invest to survive as opposed to invest to strategically expand, that I'm not entirely sure of. So bank financing, I'm going to go reasonably quickly through a couple of these here. Bank financing, as many of you know, is very much dependent on or is structured around the kinds of covenants that are incorporated in transactions, and they're going to be different, and you've got cyclical times. You've got covenant-light loans, you've got periods where you've got more stringent covenants, but if you're looking at a company that has bank financing, understanding the nature of the structure and nature of the covenants is critical. Understanding what's secured and what's unsecured is obviously important. If you, depending where you want to be in the creditor queue in a bankruptcy proceeding. Understanding the bank groups. Is a company that you're looking at, does it have a bank group that's new? Does it have a bank group that has smaller banks? Does it have a bank group that has a lot of international banks that are under significant regulatory pressure and domestic pressure? Certainly a bank group that includes a lot of the European banks. There are a lot of questions about them as a broad group and country by country, the nuances of the risks that they're facing. And as all banks are readying themselves for Basel III compliance, the capital adequacy concerns that they've got will drive what their credit profiles look like, or the credit profiles of the companies that they're interested in. Bank oversight tends to be greater than bond market oversight of the companies that they're exposed to. So you can take a little bit more comfort, generally speaking, with a company that is just bank financed, that the banks at least are going to be a policing mechanism looking after the well-being of that company. And then whether the companies are rated. And I mean rated by the large issuer paid rating agencies, because they have a special place in the market for driving what capital access will be like, because some investors will not invest in companies if they aren't rated by one of the big three rating agencies at a certain level. So I can get into that for a very long time, and I won't, but it's a question of what regulatory arbitrage exists and what people are doing and how they are going to be, whether there's forced selling for a company if they're downgraded, and all of these issues. Bond market financing. The volume of outstanding bonds for a company affects their liquidity and their future access to capital. So understanding, and certainly there are private companies that have bonds outstanding, whether they're publicly registered bonds or whether they are traditional private placements. Won't be liquidity in traditional privates, but if they're issuing, say, a 144A, there could be. What the covenants look like, whether they have strict covenants or don't have strict covenants in a high yield bond, so covenant light or not. Certainly high-grade bonds won't have any covenants of any magnitude. Security, again, is important. Where does the bond, or where do the issues that a company has outstanding, where do they fit in the overall cap structure? Again, ratings are an issue. And then what do overall bond market dynamics mean for that private company's access to capital, and therefore the ancillary risks that they're taking? So looking at bond market dynamics, what you see on this chart is the investment grade versus high grade, or high yield rather, issuance volumes last year and this year by quarter. If you were to look at 2010, the second half of 2010, you also saw robust bond market issuance, but you saw it drop off in the second half of last year. You've seen it pick back up significantly in the first quarter. Now that's a pretty healthy bond market, and understanding the dynamics of this in aggregate, and then the mix of how many high yield issuers there are versus investment grade issuers, because more private companies are going to fit into the, generally, are going to fit into the high yield category. And then what isn't on this one, this chart, is the leveraged loan volume, but that's the other component to be evaluating.
Do you see much seasonality with yours?
It's not so much seasonality as it is broader macro conditions. So I think if you were to chart concerns about U.S. downgrade, concerns about European, the overall European macro issues and downgrades of individual countries and the financial institutions therein, you'd probably see more correlations over the last 2 years of issuance than you would seasonality. So this looks at leveraged loans and high yield bonds. And you see basically the same thing. But again, it's important to be looking at the three categories: leveraged loans, high yield issuance, investment grade issuance. This is a pretty interesting graph. It's a little complicated, so let me just explain that in each one of these columns by year, you've got two graphs. The first graph is the forward maturity calendar as at the end of 2009, the beginning of 2010. The second column, or the second bar in each column, is the end of last year, beginning of this year. So if you just look at the first bars in each one of these, you'll see a very steep climb. That represented a maturity wall in leverage loans and in high yield bonds. If you were to add on it investment grade, you'd see basically the same shape of these with a significantly greater magnitude up the axis. So we had a very steep climb going into 2014, then a drop off, and then a little bit more of a wall relative to 2012 and certainly to 2011, which was down here. So with the improved bond market conditions at the end of 2010 and the beginning of 2011, you saw a tremendous amount of refinancing. And the refinancing kicked the can down the road. So you saw a drop in maturities in 2012, in 2013, in 2014. In 15, it's pretty even, and then you start to get a wall again. Investment grade, the same thing. So when looking at private company counterparties and understanding, broadly speaking, what private companies' access to capital will be, you need to understand what public company access to capital will also be. And you need to recognize that if you look at all counterparties, regardless of what you're doing with them, they fit into this broad context of needing capital at some point. And the bond market conditions were good for long enough to kick that can down the road. But if it hadn't been, we would be facing the same credit conversations and decisions that all of you are making now with that amount of refinancing next year, that amount of refinancing the following year, and there will be the haves and the have-nots. And being able to determine who's who is critically important and harder for private companies than for public. But I would always look to try to pay attention to this kind of information as much as you can. So when you get financials, if you're getting the financials, you want to accumulate as many of them as you can, as long of a time series as you can, and then you don't want to do this with them, which is just let them sit there collecting dust. You want to do something with them. The more you do with the financials, the better off you'll be in implementing them into a solution that fits whatever your respective workflows and respective business needs are. So maintaining the information, whether it's, again, through a third party or in-house, getting the, I'm not talking about putting them all in Excel, although that's better than nothing. Is that good, David? But you've got all sorts of solutions for maintaining financials. It's not just to have it in a front end that's easily accessible. It's about how dynamic you can make it and all the things you can do with it. And it's making it enterprise ready. So-called David. Standardizing the inputs, making sure that what you're getting for companies is as consistent as possible. So understanding and making sure that you're getting as consistent a set of information as possible, because you will be able to analyze that information across companies and benchmark across companies as rigorously as you can. Developing internal models or using external models is very valuable, but making sure that you're using as sophisticated a set of models as you can is, of course, more valuable. But using the data is what's most important. Make extraction simple so you can access it, and so everyone within a firm who you want to have access can access it on an equal basis. Make the access as broad as you can across your business groups. Again, ensuring security so the confidentiality is maintained. And make sure that you're in a position to evaluate public companies and private companies on the same basis, and international and U.S. companies on the same basis. Because the more you're able to do that, the more you're able to benchmark on a truly, not just valuable, but an intellectually honest way. Because the more you're allowing your public evaluation to be different than your private evaluation, and your non-U.S. and your U.S. evaluations to be different, the more you're comparing apples and oranges and you're making decisions based on a basket of fruit instead of based on a common analysis. Yes?
So we had all these to-dos, but what I'm not seeing there is something about how frequently you should even ask for statements. Let's forget about whether they're audited or not audited.
Mm-hmm.
Clearly, the integrity, of the financial information is a concern.
Right.
But how frequently should you ask?
So the question was, how often should you be asking for financials and getting updates, and how do you implement that into a process? I would say that it depends very much on what your workflow is versus what someone else's workflow is. In other words, if you're evaluating customers, it might be slightly different than if you're evaluating companies that you're lending to. But broadly speaking, what we find is people instituting at least annual reviews. But for companies that are at a higher risk, either in our case because they are at, say, 40 and below on our 100-point scale, or because they are of more some greater criticality to you by whatever measure, asking for or requiring more frequent disclosure. Or in some cases, it'll be annual reviews. If the company's ratings deteriorate or whatever evaluation you're using deteriorate X amount over Y period of time, it then triggers more frequent disclosure. So the question needs to be answered in the context of what you're actually doing in your workflow, but we see most people implementing annuals and then increasing the frequency depending on conditions. Sure. So what you do with the financials, qualitative and quantitative analysis. We would never suggest that one should be used in the absence of another. You want to look at multiple factors with whatever decision you're making. Auditing your own decision making can only be accomplished if you're establishing time series of data. So if you are collecting data on private companies that you're making decisions on, and you're getting historical data from them, and you continue to get data from them over time, annually or quarterly, that data can then be matched against the decisions that you're making. And those decisions, whether it's how you're pricing credit, whether you're working with a company or not, whether you continue to buy product from a company, what the investment, what the ROI has been on an investment that you've made, all of those things require time series of data. So trend data and benchmarking is critical. And then taking a portfolio view. So you're working with lots of companies. What are the ratings, or what are the parameters, what's the evaluation that you're doing on all of those companies, not just one individually? Because we tend to have people tend to look at companies on a more episodic basis. You need to make a decision about a company, you evaluate its credit. But evaluating that company and looking at its credit and doing that over time against all companies on a portfolio basis is, of course, just one greater step in sophistication. So this is an example of this point. If you know, in this case it was Trico Marine and our financial health rating that we plotted here, on a 100-point scale it was a 47. It's not that good. 40 and below, we've had, in the last 20 years, 90% of defaults have been rated 40 and below on our scale. So 47 doesn't tell you whether it's good or bad because it doesn't tell you whether it's going up or going down. You get some trend information that's significantly more valuable. You know that company is deteriorating. You get it early enough, you've got actionable information that you can make decisions on. If you're able to benchmark it against sector information, whether it's your sector information, our sector information, or another third party's sector information, being able to put something in context is critical. If you can then add to it your own portfolio, you have even more information, because you certainly would know that here's where you want to start making decisions, because that's where you start to see divergence. But only if you're collecting the information, only if you're analyzing it, and only if you're benchmarking it on a portfolio basis can you make a decision about an individual name that's fully informed. Very briefly, this is a case study that we did for an institution with underwriting exposure to commercial credit. They had thousands of names that they were applying their own ratings process to. This is the distribution of our ratings over the last 20 plus years on our 100-point scale here. You can see the largest concentration right here in the low 70s, high 60s area. And this was the distribution of our ratings on this particular company's portfolio. You can see that it's roughly the same shape. So the value that they were able to get out of this analysis of benchmarking historically all of these private companies that they happened to have, but they were looking at them individually, not on a portfolio basis, was to understand that the shape of the curves and the distribution was relatively similar to all of the companies that we rate. And this is that 90% at 40 and below. So being able to see that historically the profile of companies that have failed, this is the defaulter list, looks like this. They were able to assess that using us for assessment of their portfolio was going to be valuable because they would get, because their portfolio is highly correlated to all of our coverage, and this is the defaulters that come out of all of our coverage. Now, whether it's us or someone else is not, that doesn't matter. The point is using information and using it to your best ability, benchmarking and being able to evaluate individuals versus total coverage. I'm going to, in the interest of time, just go through here a little bit faster and just tell you that failing companies tend to have a profile that is identifiable if you're looking long enough and deep enough. So this group, and we did this for actually the presentation that where Seth and I originally spoke about coming here. It was an energy conference, so we took out the 72 energy companies that have failed over the last 20 years. And what you can see here, just on a variety of measures, some of which we use, some of which are just ancillary but are not part of our ratings process, you can see that that is the average for the defaulters, or the median, and this is the median for the non-defaulters. Dramatically different health profile. Companies don't get up one day and fail. They fail over time. They deteriorate. It's about looking for the information and being able to see that deterioration ahead of time that's important. Looking at it graphically, it's pretty stark, the difference between the successful companies in the energy space and those that have failed over the last 20 years. So, what value is created by analyzing privates in greater depth? Being able to understand both the individual counterparties and the risks therein and how they are represented or how they reflect on a total portfolio. Being able to create efficiencies within your workflow by having a common denominator that you can evaluate all credits through, public or private, subject to financial availability, of course. Getting leverage and scale out of your process, enabling a consistent analysis across time and across publics and privates, and as a way of backing you up, either corroborating decisions that you're already inclined to make or challenging decisions that you were inclined to make. It's more information and more information that's used strategically. It's for a smaller firm. For a larger firm, it's all of that, plus it's uniformity in process across regions and across people. And it's also across names and accounting principles. So I won't read through this except to just re-emphasize that being able to access financials for privates is, I won't say easy, but it is easier than most people anticipate, and it's easier than most people's histories have been. But the access to it is only valuable if you're doing proper things with that information. Ensuring the confidentiality of it, being able to use it for both company-specific evaluations and portfolio benchmarking is where you really start to get the compounding power out of the privates and the information you can extract from them. And being able to look at companies, public, private, U.S., non-U.S. on a common basis is absolutely essential. And then finally, so he's a little older now. This was taken about 6 months ago. And he's fully implemented his strategy. He's got lots of girlfriends. And we were driving in the car, and I heard his voice from the back say, "Daddy, you know all my girlfriends?" I said, "Yeah." And he asked me, "What happens if they find out about each other?" And it occurred to me that no matter how good your risk management program is, there's always room to challenge it and to improve it. So I'm going to stop there. Cocktails await. Happy to answer any questions right now, or we can just join up.
Companies you went over, when you're taking them into different ratings, and you're saying they went bankrupt, a lot of them will merge into other companies. Do you have something that shows, like, is it going to be viable, like, if you merge or take it over type of stuff?
Well, we do.
You had Major Petroleum in there, and I was involved in a bunch of those different deals.
Mm-hmm.
I just recognize that. So do you have something that can say, well, they might be going bankrupt, but if all of a sudden they got a cash infusion? Because I would say at least half of those were merged.
Yeah, and the qualifications to be in that default list are that they had some breach, whether that, it doesn't mean that they all just disappeared and went off the radar.
Right, a lot of them merged or were taken over.
Right, and in many cases that was the only viable alternative they had, but be that as it may, we end up doing a lot of pro forma analysis, both for acquiring entities or for investors or other counterparties, trade counterparties.
Okay, so they work in tandem.
Right, so they'll work in tandem, or they're just making assumptions. So in the energy industry like this, obviously there's an awful lot of interplay among companies. You can be a supplier and a customer and a trading counterparty with the same company. And you spread that exponentially, and you've got lots of intertwined risks. What that means is there's a lot of knowledge of these companies. So we'll find that a client will ask us to run pro formas, and now we give them the ability to do it online themselves anyway. So they can go in and they can take a company and they can make whatever modifications to join to and to see what the resulting financial health rating implications will be on any of those.
Do you have a credit monitoring thing that measures the CDSs against default or one way or the other, taking that?
Yeah, we've got a variety of derivative indicators that come out of the financial health rating that people can use and
Rank them
manipulate.
against each other, like if you had 5 energy companies that are pretty much the same, you know, and you might have some of them, some for 80 cents a dollar, some for 90, or some for 95.
We don't do it on a price basis, but we'll work with clients who are implementing it into pricing models, and we'll work with them to guide them on the best ways of that integration.
And can you apply those skill sets to like a municipality?
You're talking to this one. Since we're about 15 minutes over,
I'm sorry.
that's all right. I know you're going to lose order. If you have other questions, maybe you can ask James one-on-one during the drinking part.
Sure.
Sorry, it's not everybody's drinking.
Yep.